What's up, guys? So like I said, today's video is going to be about how I manage my 3 accounts. I have 2 regular taxable brokerage accounts and 1 IRA Roth. I have a particular strategy within each of these accounts that I'm going to discuss in this video. My longs brokerage consists of stocks and ETFs that I plan on holding for a period longer than a year. I like to keep a fairly concentrated portfolio here, as I believe in diversification leading to the concept of diversification, in which you start to invest less in your highest conviction ideas, sort of diversifying into different industries just for the sake of it. The lesson here is to do your research, develop high convictions about certain stocks, and believe in those convictions. I would say on average for this account, I hold 3 to 4 stocks at any given time. And like I said, aim to hold these stocks for longer than a year. And that is just to reduce my exposure to long-term or short-term capital gains tax. In New York, you get flossed with taxes. That's where I live. If I decide to sell before a year for any reason, so be it. I can't marry myself to the idea of holding for longer than a year. We all need to take profits at some point. Again, pigs get slaughtered concept. So if you have to pay the taxes, you have to pay the taxes. That's the end of the day. That's no big deal. You still made money. Obviously, there's some risk to holding so few positions. So in addition to the concentrated basket of stocks, I hold solid ETFs such as ARKK, ARKG, and QQQX. The ARK funds are actively managed funds. They invest in disruptive tech companies, and I believe they are definitely going to outperform the broader market in the next decade. For a 0.7% expense ratio, you are getting an actively managed fund that transparently publishes their holdings every single day and actively manages the fund. They're buying stocks that they think are going to rip in the short term, and then they're reducing their position when the stock runs and adding it to other things they think are going to run. It's an actively managed portfolio. It's going to do well. If you don't mind paying the expense ratio, I think it's a great long-term hold. The other ETF I hold in the account is QQQX. This is a covered call ETF. It employs the covered call strategy and yields around 6%. With dividends reinvested, the fund has matched the overall performance of the NASDAQ. So the idea here is to provide some dividend income for the portfolio while still being exposed to the overall market. Long-term QQQX, the dividends produced from it could, be a supplemental income to me. I don't think there's anything wrong with holding QQQX. So back to the stocks. So the longs I seek to hold in this portfolio are disruptive tech companies that I believe have the potential to exponentially increase their revenue in the next 5 years. If you can identify a company that's doing this currently or likely to do this before the stock price moves, there's a good chance that you're going to capture the best run-up in stock price with that company. So you can find stocks that are going to multiply their revenue in the next 5 years before the market realizes that they're going to do this. And that is the best way to find great stocks that are going to grow, break out, be multi-baggers. I tend to look for profitable companies that grow their revenue at least 15% year over year. That would be a minimum. I also look for stocks which have the potential to create a future moat and are also developing multiple income streams. These are huge green flags. The most powerful moat in today's market is sort of a network effect. I've talked about this in some of my other videos. It's when more users getting onto the product actually improves the value of the product. Again, I've talked about this with CrowdStrike. CrowdStrike, the more clients they get, the more powerful the cybersecurity software actually gets. I believe this is going to happen with Clover. The more clients they get, the more powerful the data that they own is going to be, the more powerful the product's going to be. That's just my thesis on the stock. So I'm not married to the idea of profitability. Obviously, Clover is not profitable on an overall basis right now, and I have a big position in them. But I'm definitely looking at the growth potential, the revenue growth potential of a company. That is the most important thing. Can the company grow revenue? What is the total addressable market? Is it a massive market that the company has an opportunity to tap into? If yes, probably a good investment. For transparency, Last year I held Tesla, Square, the Trade Desk, Intel in my longs portfolio, along with the ARK funds. I recently got out of TTD and Square in January on recent NASDAQ weakness, and I rolled the profits from those two investments into new stocks, which I thought would outperform them this year. I'm still very bullish on those two companies for long term, but I had to make the decision that I'm in this game to gain capital, not to be married to stocks that have made me money in the past and stocks that I love, because I do love Square and the Trade Desk. We'll see how this concept plays out for me. It could be a pretty bad strategy. Obviously, you might just want to park your money in your winners. They won for me pretty well, but now I'm just trying to compound those gains into new stocks that I think are going to do well. But yeah, in this long account, the goal is to hold for at least a year, because otherwise you're getting flossed with taxes. For transparency, right now in this account, I'm holding Tesla, CLOV, and a slightly reduced position in TEL after I sold off my initial cost basis around $4. But don't worry, Tesla gang, TEL gang, I added back about half of what I sold under $3. So I'm, just about full position in TEL again. In my other taxable brokerage, I swing trade for a period ranging from a few days to a few months. Swing trading is a difficult endeavor and requires some discipline to be good at it. After failing a lot at it and trying to learn more about the concept of swing trading and day trading, I started to develop and stick to a set of rules. First, it's good to identify themes and trends in the market, which will help you identify which stocks might run. Then I take a look at stocks within a sector that I feel are going to do well. I check out the charts and do a research in the background of the companies and see what the quality of the company is. Companies with good fundamentals and solid management teams, they reduce your downside risk. It also pays to check out the sentiment on FinTwit, StockTwit, Wall Street Bets, whatever online resource you like to use, as stocks that are highly talked about are usually bound to move at some point. They're going to generate the volume necessary to create big moves. So once you identify a stock that you want to swing trade, this is where you really need to start to show some discipline and follow rules. When I decide I want to start a position in a stock, I buy no more than 10% of my total swing account. So, if your account's $50,000, you're buying $5,000 worth of shares of your initial position. Ideally, you're buying close to a support level, but if you aren't, it's okay because it's not a major part of your account yet. Once I have the small position, I watch the stock's price action over the course of a few days, maybe a few weeks, and check for points of support and resistance. This can be identified in multiple ways. There's tons of resources to help you identify support and resistance. But basically, support is price points where buyers flock in, and resistance is where people start to take profits on a wide basis. So what I do after I have my initial position of 10%, I'm allowed to add at support levels up to a third of the whole swing account. So what that means is if I have a $50,000 swing account, I can add up to have $16,000 worth in any single stock. Once I have my full position in a swing trade, which sometimes I don't reach my full position just because either it didn't tap the support at levels I felt comfortable with, but you don't have to have a full position in any swing. You can have multiple swings. But the key here is once you have your full position in any particular stock, you set a 10%, or I set a 10% stop loss below my current cost basis, which should be very close to a support level at this time. This means that if it does hit the stop, I can never lose more than 3% of my account on any singular trade. Risk management and staying in the game long term are the most important concepts for traders to master. By following this adding strategy, I become more comfortable and confident in my positions, and I really start to build conviction in the swing if it's a multi-month swing or a few week swing. When it comes to taking profits, I sell 25% of the position when it hits resistance levels. I sell 50% on the breakout when it breaks through resistance levels, and I sell the rest if the trend reverses, which it's always going to. I just hold the last 25% to try and capture the whole move. Once the trend reverses, then I'm out of the stock. The stock then goes back on a watch list to watch for future tests of new support and resistance, which could provide good opportunities for trades in the future. So once I trade a stock and make money or I lose money, I keep it on a watch list. It's another opportunity in the future. Now, one thing about having rules, the thing that ruins most traders is that they don't follow a set of rules. Lapsing from your rules even once will cause you emotional pain if you lose money, or gambler's euphoria if you make money. These emotions, obviously it's good to make money, but these emotions will cloud your judgment 100% of the time and cause you to make future errors in your trading. I can tell you many times when I deviated from the rules, made some money or lost some money, which is fine on one trade, but the emotions generated from not following the rules caused me to make mistakes in future trades, which means I left money on the table or I added to losing positions. It's just not good. You have to follow your rules. They don't have to be my rules because every trader has a different niche. They have a different style. You just need to create your own rules of risk management, when to sell, when to buy. And if you just follow those 100%, it takes your human emotion out of the process. This is why I read in a book, I forget which book it is, but this author talks about two trading experts. One thought a stock was a short, one thought a stock was a long. Throughout the week, they traded the stock and both made money. Why? Because they're following their rules. It doesn't matter if the stock's a long or a short. If you follow your rules long term, you either manage your risk, you're not going to lose that much, or you're going to come out on top of the trade. And that's what every trader should feel confident in following their rules. So, I mean, there's tons of books you can read about how to make rules, but I think what's most important is that every individual sort of makes rules, find their niche, and then they can adjust their rules as they learn more, as they find out what works for them. But yeah, making rules is the most important thing. In my swing account right now, I'm swinging UWMC and LOTZ with basically all of FinTwit. The stocks are getting sort of manipulated right now, in my opinion. I think they're at least 50% gainers from these levels as of today. But yeah, so I still have I have a few other positions. I'm swinging ISUN right now, and I'm swinging Thunderbird THBR, which is going to become Indie Semiconductor, which makes semiconductors for electric vehicles. So yeah, those are smaller positions than LOTZ and UWMC, but again, when it hits resistance levels, I can add to them. And then once I have my full position, I'll set my stop 10% below the current stock price. So yeah, so that's how I swing. So then the last account is the IRA Roth. I just hold, in this account, very simple, I hold again, it's concentrated like the longs portfolio, but instead of hyper growth companies, I like to invest in blue chip tech companies and ETFs. So I have a little bit of SPY, I have a little bit of QQQ, I have a little bit of ARK funds. And then for the basket of stocks, right now I'm just holding Apple, NVDA, and BABA, which obviously are just proven compounders. They're going to do very well. They're blue chip stocks. Like, you know, there's not as much volatility in this portfolio because of the stocks that I choose to hold. And it is my retirement money. So, you know, I'm willing to go balls to the wall on my swing account and my growth account. Because I'm really trying to create financial freedom for myself. But in my Roth, like if I lose everything in my long and swing, like I'll still have a very solid amount of money in my Roth for the long term. Like I'm going to be a millionaire long term. But you know, right now I'm young and I'm trying to build capital in the other two accounts, so I don't mind being a little aggressive. So yeah, so that's my video on my 3 different accounts. Let me know what you guys think about my strategies. Let me know what you think about any other stocks discussed in the video. Do you like them? Do you not like them? If you guys have swing trading or day trading rules, please let me know in the comment section what you like to do. What's your style? Feel free to follow me at 10xbaggers on Twitter. I tweet usually every day. I'm on there just following what's going on, giving my 2 cents, which not everyone likes. So yeah, please hit like, subscribe if you like the video, and of course, happy bagging, folks.